Hi class, this video is going to be the final video that I make on the topic of balance day adjustments, and it is going to be from your chapter 19 of your Macmillan textbook, which focuses on balance day adjustments on revenue, and this one is on a topic called accrued revenue. If we look at the learning intentions for this video, we have a number of things that we want to achieve. Ultimately, I want you to be able to understand how to prepare the balance day adjustment for accrued revenue, but there's really three things that entails. I hope as a successful video and a successful lesson, you can outline the meaning of accrued revenue and probably just as importantly, identify the transactions that an accrued revenue might be the balance day adjustment. Once you've identified it, I hope you can prepare the adjusting general journal entries and then understand how to use that general journal entry to post to your general ledgers. And then what is maybe unique for accrued revenue, understand how to treat this transaction in subsequent periods when we receive the revenue, and that will make sense in a second. So what is accrued revenue? Accrued revenue is simply revenue which has been earned but not received. And that might sound a bit funny. How can we have earned something but not have received it? But there are a number of examples. And examples include, and probably the most common one, is a term deposit. A term deposit is a bank account that companies often invest in, that a bank will then give you a fixed term interest at the end of the period. What's unique about this account? You only get paid the interest at the end of the period, the end of the investment term, and you can't take the money out during the period. So a business, for example, might invest in a 12-month, so 1-year term deposit, which pays 6% interest per annum. They will not receive the 6% interest and their money back until the last day of that investment, which is in 12 months' time. But they earn revenue each day and each month that this occurs, and we need to do an adjustment for this. The other one is royalties and commissions. This is what some businesses will operate, where they will earn royalties or commissions for every sale that they make. For example, a real estate agent business might earn, for example, 2% of the sale price of a house. And once they make that sale, they have in fact earned it, even though it might take them a long time to actually receive that money. Now, because the revenue the amount has been earned in the reporting period, it must be recognised as revenue. And this is because there is this important accrual basis accounting assumption that says we must report revenue when it is earned and expenses when it is incurred. This obviously requires a balance day adjustment, or otherwise we'll never record this revenue in the period that it has been earned and occurred. So we're going to record revenue. We also need another side of this transaction, and this is what we're going to do. We're going to report this as a current asset. This is a current asset as the revenue has been earned and will bring a future economic benefit. So it meets our definition of an asset, which requires something to be a resource to be controlled and there to be a future economic benefit. So that's the theory, that's the definition. Let's go through an example. So let's explain the adjustment. So on the balance day, we need to adjust for the revenue that has been earned. This involves two aspects because it's two-fold effect of accounting. Firstly, we're going to have to add the extra amount earned to the revenue account. And secondly, we're going to have to create a current asset, as we mentioned, called accrued revenue to show the amount owing. And it won't be called accrued revenue because it will say accrued and then what type of revenue has been accrued. So it might be accrued interest revenue, accrued sales revenue, for example. Let's have a look at an example, a really common one, probably the most likely type of one you're going to get in a SACRA exam. For example, if a business invests $10,000 cash in a term deposit for 12 months at 5%, and they did it on the 1st of July and the reporting period was on 31st of July, we recognise, because of the term deposit, no interest will have been received in the reporting period. So invested on the 1st of July, By the 31st of December, we will not have gone through 12 months, so we haven't received any interest. But have we received any, and how much? Naturally, the accrual accounting assumption requires that 6 months interest revenue be recognised in this period, even though we haven't received it. Where did I get the 6 months from? Because we put it into the bank on the 1st of July, our reporting period is the 31st of December, that is 6 months long. This is almost always the first step of these type of questions, working out how many months has occurred. How much interest has been earned in this? We need to look at the total investment. In the end of the 12 months, the $10,000 will have earned 5% per annum, and that would equal $500 of interest. We have earned 6 months of the 12, so we have earned $250 of interest on our balance day. And this is forming the basis of our adjustment. That's actually the hard maths that we need to do. Now we just need to think about the general journal's impact of debits and credits. So how do we do this adjusting entry? Essentially, it will look like this. Firstly, we're going to do the adjustment. We're going to recognize that we have accrued interest revenue and interest revenue. We have a new current asset. Assets going up is debits. So the first one we're going to record is an accrued interest revenue of $250 as a debit. Our asset going up by $250. This is because we're recognizing the second part of this transaction that we've actually earned revenue, so we need to record revenue. This revenue is interest revenue because it is a term deposit gaining interest, and revenue going up is credit. Our narration here, because it's a balance day adjustment, will always start with adjusting entry, and then we've said here it was for 6 months interest earned. Now you need to be really careful in these questions because that's not the final thing we need to do as part of this transaction on the 31st of December. We have recorded revenue as part of this adjustment, and what happens to revenue accounts on the balance day? They get closed and transferred to profit and loss summary. So we balance out our interest revenue or close out our interest revenue account by doing a debit, so our debits equal our credits, and our other side of this transaction, the credit here, is profit and loss summary, transferring it to our scorecard to determine profit. So what's the effect on our income statement and balance sheet? We're going to have $250 more of revenue reported, and it's going to be reported as interest revenue, and this is in the other revenue section of your income statement, one that isn't used too often. This will ultimately, because revenue is going up, increase our profit as well. Our balance sheet is going to be impacted by $250 current asset, which will be reported in the current asset section of our balance sheet as accrued interest revenue. This will ultimately increase our assets, and because there's no impact to our liabilities here, our owner's equity section will go up. And this makes sense because we're also recognizing profit is going up because of this. So how will our ledger accounts look? We have two that are impacted. Our interest revenue, remember we recorded interest revenue going up by $250 in our first part of this adjustment, and that was a credit, our right-hand side. We have closed this off as well to close it to make sure our debits equal credits, and that's the debit side of this transaction with the cross-reference profit and loss summary. On the balance day, our accrued interest revenue asset account, which is a current asset, is $250. $250 was our debit because assets going up are debits, and we've basically picked up all the three entries in our general journal, and I'll go back to it. 3 of the 4 impact accrued interest revenue or interest revenue, so there are 3 postings to these ledger accounts. The hard part that we just need to remember about accrued revenue is we're going to receive the interest later. So we need to be careful when recording this to not overstate our revenue. Remember, the accrued interest revenue account is just a temporary asset. What happens when the actual interest revenue is received and we receive $500 of cash? How do we record that? The temptation is to say cash goes up by $500 and revenue goes up by $500. But we need to be careful. If we did that, we would overstate our revenue by $250 because the adjustment has already recognized half of it has been earned. So one half of this subsequent receipt of cash is going to be recorded as the reduction of our current asset. We're essentially swapping assets here. We've received the cash at bank going up by 250, asset going up as a debit, to recognize that the current asset of accrued interest revenue of $250 has gone down. I'd like to think of it as a bit like the accounts receivable transaction. When they pay us back, we're just swapping assets to recognize the cash has been received and the other asset no longer exists. The other $250 we receive would definitely be recorded as cash at bank and interest revenue. And that is how we record and make and prepare balance day adjustments for accrued revenue. I hope by the end of this video you understand the meaning of accrued revenue, can do the general journal entries for accrued revenue, and also do these in the subsequent period when we receive the revenue. Keep practicing your balance day adjustments.